Understanding cash reserve ratio and repo rate. Imagine a bustling bank where deposits are made and loans are granted. To ensure financial stability and control the money supply, central banks utilize tools like CRR and repo rate. Cash reserve ratio, or CRR, is a crucial tool used by central banks to manage the money supply within an economy. It is the percentage of deposits that banks are required to hold as cash reserves with the central bank. This ensures banks have enough liquidity to meet withdrawal demands and acts as a buffer against financial shocks. The RBI also has the power to change the cash reserve ratio between 3% to 15% under the Reserve Bank of India Act of 1934. Now, let's talk about another important tool, repo rate. The repo rate is the interest rate commercial banks pay to the Reserve Bank of India when borrowing money from the RBI. It is adjusted by the central bank to control inflation or encourage economic growth. A higher repo rate makes borrowing more expensive for banks, leading to reduced lending and potentially curbing inflation. Conversely, a lower repo rate encourages borrowing and stimulates economic activity. How do CRR and repo rate work together? When the central bank wants to tighten monetary policy, it can increase the CRR and raise the repo rate. This restricts lending and reduces the money supply, which can help control inflation. Conversely, when the central bank aims to boost economic growth, it can lower the CRR and reduce the repo rate. This encourages lending and increases the money supply, stimulating economic activity. In summary, cash reserve ratio and repo rate are powerful tools used by central banks to influence the money supply, control inflation, and stimulate economic growth.